When it comes time to think about retirement, there's a lot to consider. From healthcare issues, cash flow issues, tax issues, investments, long term planning issues. It can seem completely overwhelming. I'm Brent Hause with Fortuna Investors, and today I'd like to spend some time reviewing some of these topics, and hopefully you're going to walk away feeling educated and empowered to tackle these issues. Now, in addition to this video, we provided our ultimate guide to retirement readiness checklist here as well. This is free to download at the link below the video. So please go ahead and download that. It's a great resource. Now, ideally, you should start considering these topics well before you retire, as more time allows for more flexibility to optimize all of these areas. But don't worry if your retirement is right around the corner. The fact that you're thinking about this stuff is great. And no matter where you are on your journey, there are always elements of your plan that can be optimized for your benefit. The last thing I'll note before we get started going through these topics is if you need individual help, please reach out to us at Fortuna Investors. At Fortuna, we're both investment managers and comprehensive financial planners. We are fiduciary advisors, which means that we're both morally and legally obligated to act in your best interest, and we'd love to help. With that, let's chat about some of the top things to think about as you head into your retirement. The first thing you want to consider is your retirement vision. Do you have a blueprint for how you want your retirement to look? The happiest retirees that we know, well, they retired to something, not just from something. So take some time to think about it, dream and envision what you want your retirement to look like. The second thing you want to consider as you head into retirement is cash flow. You want to have a good understanding of how much you're going to need to live the life you want in retirement. The way to do this is to look through your budget today. Think about what's going to change, what expenses are going to go away in retirement, what new expenses might arise, and get an accurate picture of how your budget is going to look in retirement. As part of considering your cash flow, you're going to want to think about your income sources. For instance, do you have a pension? If so, do you know how you might elect to take that pension? There are typically multiple options for taking your pension, and you want to consider how those options will affect your level of income now and over the course of your life. And not only just your life, but your spouse's life in case you predecease your spouse. Another important topic is Social Security. The amount you receive from Social Security each month is going to depend on, amongst other things, when you actually decide to start taking that Social Security. Your Social Security can be affected by earnings. So we work with a lot of clients who are semi-retired. And the fact that they're still receiving income is an important consideration as we optimize when they decide to start taking Social Security. So that's a really important thing that you want to keep in mind. For those who are married, you want to consider what the best strategy will be to maximize income over the course of both of your lives, and what strategy best protects a surviving spouse after one spouse has passed away. If you were previously married, you may even be entitled to what's called a spousal benefit, which is based on your former spouse's Social Security benefits. Third, you want to consider your investments. As you retire, you want to consider how your risk tolerance might change, how your investment objectives might change, and if your investments themselves need to change. The 5 years before and after retirement are sometimes called the retirement red zone because big losses in the market in those key years can have an outsized impact on your investment accounts and thus your cash flow for the rest of your life. Remember, if your portfolio loses 30% of its value, it takes a 43% return to get back to even. That's just portfolio math. If you're taking a distribution from your investments into a declining market, the gains required to tread water are even higher. So if you're taking distributions, you're not going to need a 43% return to get back from a 30% loss. You're going to need a much higher return than that because you're taking money out of a declining portfolio. This is really important to realize because a lot of people invest very heavily in stocks here in the United States. The S&P 500, it's the most tracked barometer of US stocks here in the US. And it's actually seen 4 periods of loss of 30% or more just since the 1970s. So you want to make sure you have a well diversified portfolio, and that should include not only US stocks, but foreign stocks, foreign and domestic bonds. And you want to have exposure to alternatives like gold, real estate, oil, and other commodities. And this is because that diversification can help buffer your portfolio from bear markets in the US. Beyond simple diversification, you can integrate strategies like trend following, factor investing, and those are going to help minimize downside and potentially provide upside outperformance. And this is one of our specialties at Fortuna. And you can learn more about that by watching our video on our investment methodology on our website. Now, ideally, you're thinking about this again well before retirement. So it's not just like a switch flips when you retire, but you're doing a more gradual change over time to align your portfolio with how your risk tolerance is changing as you're heading into retirement. For the business owners out there, it's likely that your business itself is one of, if not your biggest financial asset that you have. So for business owners, you want to think, do you have an exit strategy? Have you had a valuation done on your business? Are you preparing the business for sale and working to maximize the sale value? Are you putting the processes in place that are going to help a buyer come in and do well with that business? That's all going to increase the potential value of the business as you're looking to sell it. Additionally, you want to think about how you might structure the sale in order to reduce taxes. Continuing along on the investment considerations, do you have any annuities or other liquid investments? Do you need to look at your options around those to determine what your best path forward is? You want to make sure you're reviewing those accounts and making sure that they all still have a purpose in your financial plan. Every asset, every bucket of capital in your financial plan should have a purpose that's relevant to you. And so you want to be reviewing those accounts and making sure that they all still have a purpose. Another consideration is, how are your accounts structured? A lot of people, by the time they reach retirement age, they have all sorts of accounts all over the place, right? They have 401ks, they have Roths, they have traditional IRAs, they have brokerage accounts. And a big part of getting ready for retirement is just getting organized. Can you consolidate all of your 401ks and IRAs into a single account? Can you consolidate all of your brokerage accounts into a single account? Doing this is going to help you stay organized and make everything run smoother for you as you make the transition into retirement. The fourth consideration is, what kind of debt do you have? Credit card debt, auto loans, mortgages. A lot of people approach retirement with debt. And if you haven't considered strategies for paying that down, now's a great time to think about it. We actually see a lot of our newer clients come to us and they're carrying high cost debt on one side of their balance sheet and low return investments or a significant amount of cash on the other side of their balance sheet. This creates inefficiency and it can often easily be solved. So you want to be looking at your finances holistically to be sure that you're managing debt effectively given your entire financial picture. So you're not needlessly wasting money due to high interest costs and that kind of thing. Fifth, you want to be thinking about health insurance. If you're retiring before the age of 65, you won't be eligible for Medicare. So you might consider COBRA from your previous employer. You might consider purchasing healthcare from the marketplace, and you could be eligible for subsidies depending on your income. You want to be particularly mindful of utilizing tax strategies like Roth conversions here, so they could eliminate or reduce those subsidies. As you consider to think about healthcare, you want to be thinking about long term care insurance and life insurance needs as well. Believe it or not, many of our clients come to us what we call overinsured, meaning that they were sold more coverage than they actually need, or maybe they're improperly insured. They have the wrong type of insurance. The type of insurance they got is inefficient, it's fee ridden, and perhaps as a substantial opportunity to reduce your cash outflow just because you're paying way too much for insurance that you actually really don't even need. So you want to be properly insured. I'm not saying that you don't want to have insurance at all. That's definitely not what I'm saying. But you definitely want to have the right amount of insurance, and you want to be careful that you're not overpaying. With long term care, you want to think about your assets, and you want to think about whether or not it makes sense to buy long term care insurance or potentially just self insure with the assets that you already have. Your sixth consideration is going to be tax planning. If you've done a good job of putting money away in tax deferred accounts like 401ks, traditional IRAs, you're likely to be facing some pretty large required minimum distributions as you age. And those could potentially put you in a higher tax bracket than you expect, and definitely a higher tax bracket than you want, right? So, one way you might reduce those RMDs or required minimum distributions is through a strategy called a Roth conversion. But again, that's something you want to consider in light of how it might affect your other areas of your financial plan, right? This is all very holistic and needs to be looked at holistically. There are many estate issues to consider as well with regard to tax planning. We'll cover some of those later in the video. Number seven, you want to consider your living situation. Think about where and how you want to live. Do you want to be a snowbird? Do you want to live in Florida where it's sunny all the time? Or do you want to live closer to your grandkids? Do you want to move to a low cost state? Do you have a substantial portion of your assets tied up in your primary residence? Are you thinking about selling your home and downsizing in order to free up cash to do the things you want to do in retirement? We see many, many people considering leaving high tax states like California and New York, moving to places like Nevada and Florida in order to mitigate taxes in retirement and just reduce their cost of living overall and really be spending more money on what they want to do rather than spending so much money paying the government. So you want to have a plan and a vision for this as you prepare to retire. Number eight, you want to be considering long-term planning issues. So, do you think your estate is going to exceed the long-term exclusion amount? Some people retire and their level of assets is such that they're going to spend those down over the course of their lives, and that's fine, that's great. Others are going to retire with substantial assets, and they find that despite the fact that they're no longer earning and they're actually now spending out of their investments, but because they have such a large asset base, their assets are going to continue to grow throughout their lives. So you want to not only be looking at how much you're going to have in retirement initially, but how those assets might actually grow over the course of the 20 to 30 years of life in retirement. And if there's going to be a significant tax consequence for your heirs due to the size of the estate. Continuing along, if you're charitably inclined, there are structures like donor advised funds, or you can make charitable qualified distributions. And those can all help minimize your tax bill and maximize the impact of your charitable giving. So you want to be thinking about that estate plan as well. When was the last time you looked at your estate plan? How about your will? How about your trust documents? Are the folks who are listed as your beneficiaries and executors still the people you want listed in those roles? Are they even still alive? Are the assets that you want in your trust actually in your trust? That's a really important one. A lot of people create their trust, but they don't realize that a trust is just an empty vessel until you actually title the assets or move the assets into your trust. So that's all really important stuff that you want to be considering as part of your long-term planning issues. Now, the last thing I'll mention here is you want to consider your health. Nothing can derail a great retirement like health issues, and you don't want to be surprised by a major health issue, especially right after you retire. So get checked up. Know your physical condition and any issues you might have before you retire. And that's going to go a long way in terms of creating peace of mind and helping you plan for the retirement that you want. So So these are just some of the many issues and more that you should be considering as you're preparing for retirement. It can seem overwhelming, but again, we want to help you through it. So we've provided that copy of the Ultimate Retirement Readiness Checklist. Again, free for you to download. Go ahead and look for that below the video. And if you found this useful, take some time to watch some of our other videos on our website. Review our website for more insight into these issues and many others. And if you'd like help with your specific situation, please don't hesitate to reach out. At Fortuna Investors, we help people with this stuff every day, and we'd love to learn more about your unique situation and see if we can help you optimize your financial future. You can reach me by clicking on the reach out link below, or you can email me. My email address is brent@fortunainvestors.com. Love to spend some time with you, love to get to know you and see if we can help. So thank you so much and happy retirement planning.